On Wednesday, October 26th, bonds got a nice rally in the overnight session by their own volition. U.S. traders didn't push back against any movement seen during the overnight hours, so we started the day being up 28 basis points and stocks were down 24 early on. Friday's PCE inflation data is not likely to show any big improvement since it is the same time period as this month's CPI inflation data that showed higher inflation. Still, we're a week away from the Fed meeting, and if markets want to continue to believe that the Fed is going to be ready to start pulling back a little bit, that will help interest rates. We had a letter from Ohio Senator Sherrod Brown that he sent to the Fed asking them to slow down on the rate hikes, making the case that the hikes will tank employment and reminding them of their dual mandate, half of which is maintaining high employment rates. Odds are still of a 0.75 increase in November and a half-point increase in December. We also got new home sales, which fell 11% in September at a 603,000 annual pace, stronger than the estimates of minus 13%. Sales were down 17.6% year over year. There were 462,000 homes for sale at the end of September, but only 56,000 or 12% were complete. So this goes back to my continuing complaint about builder sentiment. You are still selling homes at a faster rate, way faster rate than you can even possibly build them. And things are bad in your world, especially when the median price rose 8% last month. So your sales price went up 8% last month. You're selling stuff still way faster than you can possibly build it, and your sentiment is down. I'm just going to call them crybabies. News reports are that 24% of Pulte contracts were canceled last month. Redfin said that it's 17% on existing homes. However, this is another chunk of information to take with a grain of salt because last year when rates were great, 14% of contracts were canceled. So it's not a big change. Reports are that 22% of homes had price drops. Another thing to take with a grain of sand, because if you try to sell a $500,000 home for $540,000, but you decrease the price down to $520,000, is that really a price drop? Still, 46% of all home sales had multiple offers. At the end of the day, we were up 31 basis points on the day, which was a bit of a retreat versus midday gains that were around a half point. We are still in the upper half of that wide range with some new technical data. We have the 25-day moving average at 99.141, which is a little bit higher than the 98.83 we closed at today. So hopefully we can make a run and get up into that new range tomorrow. We also had an earnings call from Mortgage REIT AGNC, which is a huge buyer of mortgages and mortgage-backed securities. They discussed how wide MBS spreads have become. This means that the spread, or the amount of interest rate differential between the 10-year Treasury and the 30-year mortgage-backed security, is at some pretty close to all-time highs. Spreads right now are wider than they were in December of 2008 when the financial crisis was peaking. They're wider than they were in early to mid-2020 when basically all buying was frozen by these REITs, beset by margin calls. Can they go wider? Sure. But we're seeing historically unprecedented market, and these spikes don't last very long. Over the past 10 years, MBS spreads have averaged about 78 basis points, and they're at 190 right now. So that means that if the 10-year yield stays the same, there is a built-in improvement of up to 112 basis points on mortgage rates. In other words, we could see rates fall in the low 6% range over the next few months, even if the Fed continues to raise rates and the 10-year stays where it's at. Although the 10-year won't stay where it's at, though there is some chance of improvement just by easing of risk. So keep that in mind.